Today I'm going to break down how we achieved a 104% return in boring IBM, beating the S&P 500 in the process. I'm Sam Kovacs, co-founder of the Dividend Freedom Tribe, a service that we sell on Seeking Alpha to individuals like you who are seeking to build a portfolio of dividend stocks which will enable them to live off of dividends in retirement. All of our members receive weekly equity analysis on our universe of 120 hand-picked dividend stocks, as well as buy list, watch list, sell lists, free model portfolios, and tech tools, and a community of dividend investors which interact on our live chats. So, exactly 4 years ago, we said that it was finally a good time to buy IBM. We entered the stock at a price of 114, and today IBM trades at 191. When we include the dividends received on IBM, the IBM has returned a total of 103.94%, doing significantly better than the S&P's 80% return over that period. Today I'll be breaking down the history of our trade with the hope that it will give you a clear idea of how long-term oriented dividend investors can pick their entry points into quality stocks as well as pick their exit points. We didn't just buy IBM. As you can see, during the past decade, IBM's valuation relative to its dividend, and this is one of our proprietary DFT charts. If you're not familiar with it, I've recorded a video explaining how they work in detail, which I suggest you check out. But over the past decade, IBM's valuation relative to its dividend got more and more undervalued. Why was this happening? IBM was undergoing a transition where its cloud and new growth segment businesses were yet to overtake its legacy business, which was declining at a 10% rate every year. However, in March 2020, during the pandemic crash, IBM reached its bottom at around $90 per share. Since then, it has only gone up and today trades at $191, not so far from its all-time high of $200, which it traded at sometime in 2014. What this shows you here, and we got in about $113, is that you do not need to get the absolute bottom to do well in the stock market. What is important is that you do close enough to the bottom and you get out close enough to the top to have the meat of the returns. Then, if you do that, you'll usually come out on top and do better, as we saw here with beating the market by 20 percentage points. So the first time we considered investing in an IBM, but ultimately chose not to, was back in 2017. At this time, June 2017, we wrote an article titled, "Don't Let IBM's Cloud Growth Cloud Your Vision." Catchy article, and as you can see, had you bought IBM at this time, your returns would have been 77%, and that's investing 3 years before we did. And as a consequence, you would have underperformed the S&P 500, which has returned 110% during that period of time, showing that timing does matter. Right. Why did we decide not to invest at this point? This was prior to the Red Hat acquisition, and we ultimately viewed that the double-digit growth in cloud would take quite a bit of time to overtake the legacy business. And we've got here what at the time IBM called strategic imperatives and its cloud business, as well as the legacy business. And this was still 58% of IBM's business and was declining at double-digit rates every year. Whereas these segments were growing fast, but it would still take time for the business to stabilize and then return to growth. A couple years later, we once again wrote an article on IBM in September where we said, didn't like it then, still not a fan. At this time, I believe the Red Hat acquisition just happened, and it was yet to see how it would integrate into the business model. But basically, what we said is that while we're seeing validation that IBM's business is improving and that the transition is underway, We wanted more clarity on the integration of Red Hat, more dividends to justify the entry point. It should also be noted that at this time, IBM was run by this woman, Ginny Rometty, which I'm sure is a very nice woman, but as a CEO for IBM, I was very unimpressed, as I believe much of the investing community was. And interestingly enough, she stepped down as CEO in April 2020 after having served as CEO for 8 years. And this led us 2 weeks later to saying, finally, a good time to buy IBM. And this was one of the first of multiple of our buy articles on IBM. But it's important for me to spend a bit of time on this one as it will break down exactly what was going on, why we decided at this point that investing in IBM made sense. So what we saw here is that IBM had a dividend yield of 5.2% at the time. And so what we said is that, well, if IBM is yielding 5.2%, we really don't need all that much of a return to be satisfied with our investment. And I'll show you why. So here we've got a little simulator which shows how much dividends you would receive in a position if you invested $10,000 in it today, reinvested the dividends annually, and the dividends grew with certain parameters and a certain yield. Here we're assuming a 5.2% yield, which was the yield IBM was at when we invested in April 2020, and we're projecting a dividend growth rate of 2%. And what we see here is that 10 years from now, assuming that the dividends are reinvested every year at this yield, well, you'd expect to receive $1,155 in dividends off an initial $10,000 position, or about 11.5% on your original investment. Of course, this includes dividends reinvested, but this is how we look at dividend streams to be able to compare lower yielding, higher growing dividend stock to a higher yielding, lower growth dividend stock. And our threshold is that 10 years from now, we should be looking at least 10% on our original investment as a yearly yield. So what this shows is that once IBM yielded more than 5%, we knew that even with the slow transition to cloud and this and that, it would be able to grow at more or less 2% per year. And this was exactly now 4 years ago, so not quite 5, but as we can see, the 5-year compound annual growth rate of IBM's dividend has been 2% per year. So we've been pretty much bang on the money with investing at a yield which would satisfy the growth rate we projected for IBM, and IBM ended up growing at that rate. So let me just move myself back to the side a little bit so we can look at the article. The second thing we said in this article was that in the last quarter of 2019, IBM broke a 5-year streak of year-on-year declines. As we said back in 2017, while we recognized the potential in cloud and in its new strategic imperative segments, we realized that it would take time for those segments to grow enough to overtake the legacy business. Ultimately, this happened thanks to the Red Hat integration, and at this point, we believed that it was a really good time to invest in IBM. We wrote about this more months later that same year, in August 2020, where we said it was the 5% yield blue chip you'll regret not buying in 5 years. Well, you didn't need to wait 5 years, you just needed to wait 4 to regret it, but you would have had plenty of times to buy IBM, right? If we look at here our DFT chart, what we see is that the fair range is 3.59% to 4.9%. What this means is that whenever IBM's price was at the top of the pink range here during the past 10 years, its yield was 3.6%. Whenever it was at the bottom of the light blue range here, its yield was 4.9%. And as we said, we were happy with anything above 5% for IBM. As you can clearly see here, in 2020, you had plenty of opportunities to buy IBM. In 2022, you had plenty of opportunities to buy IBM. Even in 2023, you still had more opportunities throughout the year to buy IBM. And so there was plenty of time to increase this position, and IBM became, I believe, one of the largest positions of our model high yield portfolio. In January 2023, we wrote an article saying that ChatGPT is a turning point in the AI revolution. Here are 4 dividend stocks to profit. This article included 4 buys, all of which beat the market since, including Broadcom and IBM. And what we said here is that IBM is underappreciated as an AI play, but that this could only last for a certain amount of time, and eventually the market would catch up and IBM would take part in the budding AI frenzy. Of course, this didn't happen instantly, as 10 months later, in October 2023, we wrote an article for our members titled The Top 15 All-Weather Stocks to Buy on that day, and IBM was listed as one of them. Sure, we'll find it down here, IBM. At this time, it yielded 4.83%, so we were still looking to pick shares up at that price. And yeah, I mean, since then, everything's gone very well, because that was not even a year ago, and the price has already increased well over 30%. Now, why are we choosing to sell IBM now? Of course, it's becoming somewhat overvalued, but at today's price, IBM is yielding 3.5%. And I do not see a strong case to say that IBM's dividend is going to grow any more significantly than, say, 1 to 3% per year over upcoming years. I'd be happy to be proven wrong, but in the meantime, there's a strong case of saying that selling into this momentum makes sense. Now, we've started selling IBM in small increments. We took off a bit of money at 170, a bit more at 185. We're going to be looking to take off more at 200, and then let the position run and potentially exit somewhere higher than that. What you need to remember is that valuations are getting out of hand in anything that's remotely related to AI stocks. Oracle recently jumped upon posting earnings as the market realized that it would also be an AI beneficiary, and any stock which is viewed as an AI beneficiary is now enjoying a real good time. But this won't last forever. However, you do want to be able to profit all the way up. Like I said, you might not get the exact top, but as long as you get out close enough to the top, you'll do just fine. And so this is what we're doing now with IBM, shaving off a small percentage of our position as it reaches new highs. This sums up our article reviewing our investment in IBM over the past 4 years. It has been a stock which has been very successful for us, but only over the past few months. What you must remember is that, like I said, there were many opportunities to buy the stock in 2020, 2021, 2022, and even 2023, which meant that for a long time, the stock went nowhere, which is why it's not only important to buy low and sell high, but it's important to get paid a significant amount to wait, as this makes it a lot easier for you as a dividend investor to be patient. As long as you're getting a consistent dividend check, which is growing year in and year out at a rate at which you're satisfied, it's much easier to stay the course until it's time to exit your position. If you like this video, please follow, as we'll be sharing much more information for dividend investors like you on how to become a better dividend investor, how you should approach investing. And if you really liked what we had on offer, make sure you go to Seeking Alpha. Click here at the Dividend Freedom Tribe. As one of our YouTube viewers, we'll give you a special price, 2-week free trial, and I can guarantee it's going to be a great experience. Once again, I'm Sam Kovacs, co-founder of the Dividend Freedom Tribe. Have a great day.